Welcome to our series Outlook 2023, and I start today with someone whom even the government listens to. I have with me Neelkanth Mishra, member of the PMEAC. Of course, today he is here as the head of equity strategy India and Asia Pacific at Credit Suisse. Neelkanth, thank you very much indeed for joining us. Well, let me start with an economy question and then go to markets and earnings. Most people have marked down the economic growth for next year around 6%, the RBI's number, mainly fearing global slowdown. What's your estimate?
No, I think that's too conservative. I think that the economy currently is doing far better than what official data reports. I think the investors, or I would say even forecasters, are struggling with what tends to happen when you see a big break in trend. Generally, trend is a friend for forecasters, and if things are going along very steadily in one direction, it is very easy to suggest if the economy's trend growth is 6.5, whether you are at 6.7 or 6.3. If suddenly you see a break like what happened during COVID and then a sharp rebound, it is not just a challenge for forecasters. Sometimes even the NSO, the official government body, struggles to put the numbers in place. So we think that the economy is a lot closer to the pre-pandemic path than what even official data is suggesting. And the slope of the curve, which is the growth that occurs going forward, is also going to be better than what consensus is at. So we are going to slow from here. We are slowing down, but we are not slowing from, say, 7.5% to 6% or 5.8%. Which is where consensus is.
Yes.
We think we are slowing from, say, 9.5% to more like 7%.
Okay.
The time at which this data gets revised up will be too late.
Yeah.
But from the perspective of those of us in the markets, I think it's already visible in revenue growth for many of the companies.
Okay. Well, the later revisions have also been lower in previous years. But, time permitting, I'll come back to the economy. Our viewers will want to know more about earnings. The global-facing sectors, like IT and all, have already seen earnings cuts. What's your estimate? FY23 itself and FY24, are we going to see big earnings cuts?
Not at all. So on earnings, I'm actually quite, as you can expect from my view on the economy as well, that we are quite positive on the 12-month forward EPS. So whatever is the 12-month forward EPS now, in December 23, it is likely to be 12 to 15% higher. Current forecast is for 15% higher number. We expect there will be some cuts. That is absolutely normal in any market, including ours. And there are, as you rightly said, many global-facing sectors, IT, metals, refiners, and I think some of those can come under pressure. But on the whole, I think double-digit earnings growth is reasonably likely.
Okay, when you say double digit, you mean mid double digit, like 14, 15% for FY24?
12 to 15% is...
Fair enough. Yeah, fair enough. I mean, that's a reasonable range to work with. Now, where does this leave markets in terms of share prices? We are already seen as guilty of too high a premium compared to our own past and compared to our past vis-a-vis other Asian economies. So will that be a problem stalling indices movement in 2023?
That has been a problem for the last 15 months as well.
Yes.
Right? So in September 21, we started flagging that, look, we are very positive on the Indian economy. We think that medium-term growth looks the best I've ever seen as a top-down forecaster. And yet, my view was that the market was going to time correct. And that's exactly what it has done the last 15 months. I have a view that I think that time correction may last another 6-9 months. Now, of the three parts of the market, right, or the three parts that decide the market level, there is the 12-month forward EPS, there is the global price to earnings, and there is the India's premium. Now, so the Indian PE are divided into two parts, global PE and India's PE premium. Now, the global PE is, it consists of the risk-free rate and the equity risk premium. So put simply, US Treasury bond yield, which is supposed to be the dollar yielding risk-free rate in the world, and what additional returns investors would want, because they are investing in an asset class which is naturally risky and volatile, which is equities. Now, both the 10-year bond yield, so the 2011 to 19 average for the US 10-year yield was in the 2.1, 2.2% range. Even though yields may fall, they are unlikely to go below 3% in the next 12 months. Secondly, the equity risk premium, given that global growth is going to be a challenge, there are geopolitical risks, ERP is also likely to rise from here. And remember, there is always a discovered number. It is never a model number, in the sense that you will see some shock on growth, you will see some shock on geopolitics, equity is correct, and that then you say, now the ERP has gone up. So both are risks. Therefore, global PE has corrected, but I think we are unlikely to see it rebounding to levels that we were at 2011 to 19. PE premium has been a very large driver of India's performance in the last 12 months, the expansion in it.
Yes.
It is now at levels where, it has been higher than this only 3-4% of the time in history. Now, there are people who want to say that, look, why can't it go to all-time highs, create new highs? Now, see, in markets, we all deal with probability.
Yeah.
So nothing is impossible. We, as sensible investors, have to work around the probabilities of something happening when it has not happened for 25 years. And so my sense is that the PE premium is unlikely to expand. It may actually moderate from here.
Okay.
And if global PE is also moderate, then the 12 to 14, 15% earnings growth that I expect in the 12-month forward EPS may be the ceiling for market performance at a headline.
Okay. But what about the argument that now we have very good domestic support for earnings? I mean, even if in comparison to other countries, we are higher in terms of premium, we look too expensive. For the domestic investor who doesn't look outside and who is now migrating from bank accounts to investment products in a huge way, can that continue to keep us expensive but still rising?
Which is why I expect that the trend will be time correction instead of a very sharp decline.
Okay.
But let's put those numbers in context, right? So insurance flows are very strong. They tend to have a bit of mean reversion in them. So you would have seen insurance companies, the largest ones, were selling in September quarter last year and were buying in September quarter this year, right? So when the stock markets fall a lot, they go and buy. When they, because they have a certain weight, and if the weights change, they tend to go in the reverse direction. So they have a mean reverting trend. EPFO is, if the 20% of incremental flow decision comes through, there will be $7-8 billion a year that can come through from that. The SIPs are adding another $18-20 billion. But remember that about 50%, 52%, so more than half of the mutual fund AUM in equities is from non-SIP retail, right? So there are, and they are very sensitive. I mean, they're very sensitive to the advantages of other asset classes. So what we have started to see, as India's ERP on Indian GSEC yields has actually gone to negative territory, meaning that Indian sovereign bonds are now cheaper than Indian equities.
Okay.
Not surprising that they are starting to buy more bonds. The real estate market. So if this large, so this can be the counterbalancing force. So I don't expect, and frankly, I mean, whether this happens or not, frankly, expecting that the crowds will go mad is not a very sensible way to invest.
Okay. No, I take your point that it's extremely tempting if the government of India is offering 7.5% and AAA companies like a Bajaj Finance may offer 8 or 8.5. It would be very tempting and difficult for equity markets to weather that competition, and real estate is also getting attractive. But let me come to the moot question. What would you therefore bet on? Will financials continue to be the darlings because now they are reasonably expensive?
Absolutely. So what we start off this choice of sectors with is, what would the price to earnings be 1 year from now, right? So on current forecasts, and how many standard deviations above or below its 10-year average, which we call the Z score. And financials are an outlier in terms of it being very cheap when you look at what the PE multiple is going to be 12 months out. On top of that, we overlay what is the risk of earnings cuts. And again, on financials, there is very little reason at this stage to be expecting earnings cuts. So I know they are a consensus buy. They have been a consensus buy for a very long time. But occasionally, you have to resist the temptation of saying something new just for the sake of saying something new, and persist with what the numbers are telling you. And I also think that the domestic economy, if there is no accident or a very tight dollar funding situation in global markets, if that happens, then there are risks to growth in India as well. But if that accident does not happen, then the probability of India growing very well is very strong. And banks and construction and cement and some of these are the best ways to play it.
Out of time, Neelkanth, thank you very much for sharing your view of 2023 and have a great one yourself. After the break, we will have the brains trust of JPMorgan, Sajjid Chinoy and Sanjay Mookim join us to give us their version of Outlook 2023. Welcome back to our series Outlook 2023. I now have the brains trust of JPMorgan with me, Sajjid Chinoy, the Chief India Economist, and Sanjay Mookim, the Head of Equity Strategy. Sajjid, thank you very much. Sajjid, I thought that it was a reasonable growth year, 2022, but this industrial output number, IIP for October, was a shocker at -4. So how does that prepare us for 2023?
Morning, Lata. That was a disconcertingly large contraction, but I must admit there was a lot of noise in that data. Okay. Remember, this was the month of Diwali. And so think of this like Chinese New Year, where there are a lot of working day losses in the month of October. And because Diwali falls at different points in different years, year-on-year numbers don't control for that, and standard seasonal adjustment doesn't work. Essentially, therefore, all the October data is going to be weak because there were large losses in working days. It showed up in exports, it showed up in imports, it showed up in IIP. But that should not mask for the more secular trend that we should be bracing for a rotation in growth away from goods, away from industry towards services. Why do I say that? Because we've got to be cognizant of the fact that exports have been a huge driver of India's recovery in the last 12 to 18 months. When we grew at almost 8.7% last fiscal year, 3 percentage points of that was on the back of value addition of exports. And therefore, their contribution to growth was almost double their share in GDP. Now, that was a year in which growth was at 6%. Global growth was at 6%. This year, we think global growth is tracking less than 3%. Next year, even in a more benign scenario where you get some kind of soft landing, global growth will be tracking close to 1.5%. So we have to brace for the fact that the tailwind that exports have given us last year and some part of this year is fading, will fade more next year, and that is going to show up and that's going to weigh on IP data. So IP has been slowing, and you should expect more slowing next year because of exports. The good news is that we're seeing in the last GDP print a rotation towards retail services. The trade, hotels, transport subsector, which for the longest time was below pre-pandemic levels, now above pre-pandemic levels. So the hope and expectation is that the non-tradable sector will pick up some of the slack, even as some of the tradable sector tailwinds of the last 2 years fade.
Okay. Got that. I'll just come back to you for more economy questions. But Sanjay, welcome. It's tempting to ask you, about the external sector and whether those IT stocks will do badly. But I'll come to that in a bit. Firstly, overall, are earnings likely to be better or worse than this year? We saw, of course, this year much lower than FY22 when we got a huge 40% Nifty EPS growth. How is 23 likely to look, FY24 rather, vis-a-vis the year that's ending?
Morning, Lata. Just a couple of points there that look, on MSCI India, we're looking at about 5% growth for FY23.
Okay.
But that weak number is probably complicated by the huge cuts we've seen in commodity earnings.
Okay.
Now, for FY24, consensus is somewhere around 21%.
Okay.
but that appears very aggressive. So I would argue that you will continue to see earnings cuts in India. But if you exclude the commodity parts, I'd say that the banks look insulated from cuts. The earnings growth should relatively come through. But the higher end, growthy, more expensive discretionary companies are the ones where we still think earnings will have to be downgraded.
Okay, okay. Let me come then to the export argument that Sajjid has already extrapolated or explained. Do you think, therefore, IT stocks are not the way to go in 2023?
We don't. We are underweight IT in our model portfolio, and we think that, look, you have this unfortunate situation where the big developed economies are probably heading into recession next year, and this will lead to weaker top-line outcomes. Now, part of that is in consensus. Analysts do have lower earnings or lower top-line growth in their models, but the stocks, some of them at least, are still above historical averages. And more importantly, people have built in margin expansion in FY24, which might be a little bit more challenging to deliver than expected. So I still think that you might get minor earnings revisions, and in any way, you will get a lower tone from management in the coming quarters as the top line slows. So we are not in a rush to buy Indian IT stocks yet.
Yeah, we got a bit of a curtain raiser from HCL Tech, didn't we, in terms of a minor warning. Maybe more will follow. Okay, Sajjid, to come back to the economy, what's your sense in terms of the capex cycle? I mean, we spent the better part of this year expecting it. Does it arrive in 2023?
We need to be patient, but recognize what the silver linings are. The silver linings are that this big drag that we've been talking about for 10 years, right, on this twin balance sheet problem has clearly abated. It's clearly alleviated. We've seen significant deleveraging by large corporates over the last 5 years. This was accelerated in the pandemic, such that corporate debt to GDP is now the lowest since 2006. So at least large corporate balance sheets are in much better shape than in recent times. Similarly, bank balance sheets are in much better shape than had been feared at the start of the pandemic. NPAs have been lower for the most part. Banks have recapitalized, and seem to be less risk averse. And you're seeing that in the pickup in credit growth. So the good news is that the balance sheets are in much better shape, and that's a prerequisite to the next capex cycle. But we need to be realistic about the current context, both global and domestic. Utilization rates in manufacturing are ticking up, but they're still at about 76%. And in a world where you worry about, a global recession of some kind next year, where growth is going to slow around the world, in developed markets, in advanced economies, India won't be able to escape that. And at a time where interest rates are at, 2-decade highs around the world, and the Fed is going to remain, high for long, for much of 2023, we have to be realistic that that's not going to be the environment in which entrepreneurs, sitting with utilization below 80, invest aggressively. So the good news is this is going to happen eventually. For the first time, we can see light at the end of the tunnel, but we'll have to be patient. This may well be a 2024 story, not a 2023 story. One last point, this just makes it more important that public investment continue to do the heavy lifting. We've seen the central government keep pushing on infrastructure spending. States have lagged this year. If you look at the first 7 months, state capex has actually contracted compared to last year. So we need for states to kind of complement the center's efforts here, because that will not only help aggregate demand, it will help raise utilization rates of the private sector such that they get closer to a private investment cycle.
Yeah, I take your point about states, but I think there is more expenditure happening in the second half from anecdotal evidence that we got. And the centre's been at it, though they are the smaller number when it comes to capex spending. We have to depend on the states. Any of the stocks you will like, Sanjay, because of that? I mean, look at the kind of order book L&T told us. It was a mind-boggling highest ever number. Capex candidates, not your pick?
Well, I think capex is a very vast sort of a phrase, Lata, and there are various segments within that as well. And if you were to follow what Sajjid is saying, the infrastructure portion should have momentum from a combination of continued central and state government push. We also would argue that capex momentum comes from real estate cycle and real estate activity picking up as well. Because of the total GFCF in India, 30% is simple home construction. And while, yes, there has been a little bit of increase in mortgage rates, we are seeing no evidence of dampening of demand. And in fact, new construction activity seems to be picking up. So rather than focusing on the hope of a corporate revival, I can actually currently see signs of real estate construction picking up. So those are the 2 or 3 pockets within the capex framework, infrastructure driven by whatever the government's doing, and real estate through a natural upcycle are the ones that we'd want to focus on.
So real estate could be in your buy list.
Yes, it is overweight for us.
Okay. Sanjay, how would you therefore be on consumption goods in general? And let me quickly pack the other one. Overall, where would you see the Nifty by end 2023?
Okay, so let me answer the second one first. Lata, we think that, look, the market remains volatile but range-bound again in 2023. So we're seeing base case very minimal returns from an index perspective. This ties in with JPMorgan's global equity view. We've actually argued that the S&P can test the lows of 22 sometime in 23 again, as the volatility drives the markets up and down. So we think the index treads water. Within the consumer pack, as Sajjid said, there should be, hopefully over a period of time, a convergence of the K. I would argue, as a result, we are overweight staples, and we are very negative on the expensive non-auto discretionary stocks in India.
Okay, and I would therefore assume a positive on two-wheelers.
Yes.
Okay.
Within the autos, the two-wheelers is a preferred space.
Okay. I'm sorry I'm out of time, but that's a bunch of ideas for people to work with when they start analyzing their investments in 2023. Sajjid and Sanjay, thank you very much for joining me, and have a great 2023 yourselves.
Pleasure, Lata.